Peter Mcguire, CEO at XM.com, joins us right now. Peter, thanks very much for joining us. I was just hearing the debate a minute ago, and my thought to you was that, the debate is a uniquely American phenomenon. Sometimes I just wonder how much one should read into it. Maybe the Americans think something comes out of these guys talking to each other, but the rest of the world is not even aware of how these debates happen, especially if you were Chinese or Cambodian or Thai.
Well, good morning, Ashu, and that's a very, very good summation. Though I will say that open dialogue, it does capture an essence of what the actual the discussion points, and when you have the one that's just concluded, that debate hall, that really changes the landscape in the sense of people asking from the floor, what would you do with this sort of question, or what's your policy as far as energy, or what's happening as far as poverty in central cities of America. And all of that taken on board, I think it just gives the political landscape, and more importantly, the man on the street, the opportunity to understand what they would do and their policies and so on. So I think it's a good thing.
Peter, just before I get into specific stocks and emerging markets, I just wanted to take your view on crude, because, my thought would be that crude has kind of an inverse relationship with supply. So if I was Saudi Arabia or Russia and I'm getting double the price on my crude, that means my revenues are being taken care of by selling half the crude. And obviously I don't have an unlimited supply of crude. Is it possible that as crude oil prices head to 54, which is the next technical level, they could actually start shooting up to 60 and then 90, because many of these countries like Russia and Saudi Arabia then actually have more bargaining power in cutting their supply because they're making their revenues because of an increasing oil price?
Well, very true, and we've got that very important meeting. I think it's going to be a very, a capstone event as far as that 30th of November in Vienna. But preceding that, yes, you could see a mid-50 sort of handle. Though, as we see higher prices, we've seen a very strong US dollar over the last, matter of 12 or 18 months against many currencies. You take on board the other side, those rigs coming back online, and when we see the US shale producers returning to market, then we're going to see, I think, more supply coming on. You've got the likes of Kashagan coming on next year, and you've got, those cheaper producers that are going to keep pedal to the metal, as you mentioned, Saudi and Russia. So I don't necessarily think you're going to see a 60-plus handle, but I've been proved wrong before. All I will say is I think you're going to see increased volatility over the short to medium term.
Are you seeing any of that frenzied activity from the Chinese and even Indian companies back in 2007-8 to buy up Australian companies, and then Australian companies using that money and their expertise in mining to go around buying all kinds of stuff in Africa, and doing all kinds of JORC stuff and trying to come up with samples so that they can sell the company to somebody else? Has that activity come back to the old levels, or is it still very quiet? Because that may give an indication of how strong the commodity cycle is.
Well, it's relatively quiet, but we've had a very, very strong uptick, as you know, in the coal market over the last, 3 to 4 months. Thermal and coking up the best part of between 40 and about 130%. So it's been a dramatic uptick, and, prices like that will carry across to other sectors. You've seen a strong uptick as far as look at crude at the moment, 50. We're only putting our minds back to February and it was at 26, 27. So, look at it on a chart. And I was just listening before I came on air with you, as far as you were saying, trading philosophies and, trading on dips and buying on peaks and so on. That sector has allowed many retail investors wonderful trading opportunities over the last, 3 to 4 months. And I don't think that's going away. But no, there's been certain stockpiling, no doubt, as far as energy across China, and they've bought very strategically over the last, say 6 to 7 months, and I think it's probably, it's good buying. And you notice that with copper and certain other iron ore, of course. So I think that once, I'm not saying that's happening at the moment, but I think it will happen in the future. You'll see more mergers and acquisitions capture the marketplace.
Peter, you brought up a very interesting point. If I heard you correctly, you're saying prices of coking coal, which is significantly used, this high-grade coal is significantly used both in steel and even higher grades in cement. Could this be indicating then, because if somebody is ready to pay 130% more, that would indicate a pickup in the steel cycle, maybe the cement cycle, and that could have major implications for a pickup in growth around the world. So when we watch coking coal, can't we read into the fact that this may actually indicate a pickup in the steel cycle itself?
Well, it could well be. I mean, you've seen a very, very strong sell-off and a washout completely as far as iron ore. It's certainly rebounded from those lows, but nothing like, back above that $100, $120 a tonne. So I think that there's only one-way traffic for a lot of those markets. You're probably going to see stronger uptick as far as iron ore in the short to medium term. And it's been good strategic buying again from the likes of China and India that have been able to buy it cheaper and reduce pricing. I feel as though that in a lot of ways the commodity cycle was probably totally washed out from 14 onwards, from base metals and rolling across, of course, to energy. And I think that you'll probably see those markets capture a little bit more of an uptick over this coming year. So I think 17 will be a bit of a recovery phase for the commodity cycle in general.
Peter, I'm just wondering, the last time coking coal prices were high, we had natural gas prices around $11, but partly the problem was that natural gas prices around the world were not converging, whereas the US was trading at $3 to $4. Maybe Australian natural gas or Japanese natural gas going to Japan was $11 because there was no convergence. Now we've seen a convergence, and natural gas prices have actually found it difficult even to rise above $3. That's a pretty strange scenario, Peter, because if coal prices rise, to me, that's a clear indicator that other energy prices cannot stay where they are.
Well, there's a very interesting point. We are awash with natural gas, and as we know, that there's huge reserves across the planet, and those big recovery fields and the likes of the Kashaghans bringing online more supply. That's where I think a handbrake is going to be across the energy sector. So that's why I don't think we're going to see $60, $70, $80, $90 crude oil, and that'll wash across naturally to the natural gas market. So as we'll see a recovery phase, and I think that if you look at the precious metal market, that certainly had a big washout in the last week or so as far as gold and silver. But if you look at energy and energy specifically, you've got that much out there. But I really do feel that we're in a different landscape, and that $40 to $60 is going to be where it tracks, and natural gas is probably going to be a $2.70 to a $4 play. That's where it'll just stay in that tight band, Ashu.
Right. Peter, would you have an idea on what's the spread for, let's say, crude or any of the metals between the spot and future prices? The reason I'm asking you this is that if I could borrow in a zero-interest country like Japan at 0%, my cost of carry is zero, and I get a straight basis. So I have to see a convergence of the spot and the futures price since I have no borrowing costs. Is that happening, Peter? Because I'm just wondering if it's just the spot price that's moving, because that couldn't be happening without the futures prices actually moving even more.
Yeah, well, true. I mean, you'd certainly want contango. You wouldn't want backwardation. And for our viewers out there, backwardation is that you see the price of future months in a negative territory. So in other words, it gets cheaper the further out you go. So you'd want the inverse of that, which is contango, to be able to borrow at zero and then to hopefully have an uptick further out. Now, there are many factors that go into trading in that market because of, naturally demand and supply. Seasonality plays a big part as far as different seasons of the year. You have different demand pictures. And more importantly, you have geopolitical context that at the present time we've got, major geopolitical across the Middle East, but it's certainly not where we were a couple of years back. But those outliers, or those inputs can greatly affect the price very quickly, and traders have got to be very conscious of that. And if they wrap themselves also around leverage, you've just got to be mindful that you've got to lock in your stops because I think that's where the majority of retail traders play with. They certainly look at the leverage side of an instrument.